As a financial advisor, one of the most common questions I get, of course for those who have any money to invest, is should I allocate my money to an RRSP or a TFSA? For fear of sounding like a politician, the short answer is, it depends. As many people may know, contributing to an RRSP provides a dollar-for-dollar deduction against eligible income. As an example, if someone were to earn a salary of $100,000 and made an RRSP contribution of $15,000, the net reportable income from the salary would be $85,000. This is calculated by deducting the $15,000 from the $100,000 and arriving at $85,000 of income. This could, in fact, even generate an income tax refund, depending on other deductions, tax credits, etc. In theory, this all sounds good, at least for the current tax year. The rub, however, is that at some point in time in the future, and under the current RRSP rules, this money will need to be converted from an RRSP to a RIF before the end of the year the individual turns 71. The government has established a withdrawal schedule which increases every year, forcing one to have to withdraw money from the plan whether they need that income or not. Just like dollar for dollar, the money that was deducted from the income when contributing to an RRSP will now be deemed income dollar for dollar and taxed accordingly. Now, should any RRSP money be needed before age 71, any withdrawal between $0 and $5,000 will immediately have 10% withheld off the top and remitted to the government by the financial institution that holds your RRSP money. After all, the government wants to be sure that you are going to be able to pay the taxes generated on the withdrawal that was made from the RRSP. Now, if you want more money than $5,000, then between $5,001 and $15,000, 20% will be withheld from the capital, and anything more than $15,000 will have 30% withheld off the top. It is possible to receive some or all of this withholding tax reimbursed, but only if you are below a certain income threshold, and only when you file your taxes the following year. Using an example, should someone need to withdraw $20,000 from an RRSP, the net amount they would receive would be $14,000, calculated as 30% withheld on $20,000, which would equal $6,000. Not only that, but to add insult to injury, all $20,000 would be deemed income in the year that it is withdrawn. If this income occurred in a year that other income was received, such as salary income, it is possible that the $20,000 could force one into an even higher tax bracket than they would have had they not withdrawn any of the RRSP money. One last point to note, RRSP room is generated annually based upon a percentage of eligible income. Once that RRSP room is used, it can never be recouped or regenerated. Now, let's look at a TFSA. Unlike the advantage of an RRSP, a TFSA deposit does not provide a deduction for any contributions made into the TFSA. Like an RRSP, all the growth that occurs within a TFSA is tax sheltered. However, when a withdrawal is made from a TFSA, there is no tax attribution at all. Using an extreme example, if I were to invest $10,000 in a TFSA into a publicly traded company, and those shares grew to be $1 million over the course of 5 years, I could withdraw that $1 million and receive no tax on the growth of that money whatsoever. Furthermore, the following year, I could redeposit the $1 million withdrawal back into my TFSA. Put another way, and unlike an RRSP, one can recoup the TFSA room the following year from any withdrawals made from a TFSA the year previously. If they do not have the money to do so, they could even carry that room forward indefinitely. Another difference between a TFSA and an RRSP is one does not need any qualifying income to create TFSA contribution room. One only needs to be the age of 18 or older and can contribute the maximum amount as outlined by a government-generated schedule. Like an RRSP, should one not contribute to a TFSA, that room carries forward. As an example, if a person turned 18 in 2019 and wanted to make their maximum TFSA contribution in 2022, it would be calculated as $24,000 or $6,000 for each year the person was eligible to contribute, but to that point did not. On occasion, the government will increase the TFSA limit, which most recently occurred at the beginning of 2023, increasing from $6,000 annually to $6,500 annually. Finally, unlike an RRSP, in a TFSA there are no forced withdrawals beginning at the age of 71 and increasing every year thereafter. In summary, and in my opinion, the TFSA is a lot more flexible and a lot less punitive than an RRSP. However, the major difference is not receiving the deduction for the contribution into the TFSA. What I often suggest to clients is to contribute to your RRSP to the extent that you are going to bring your taxes owing down to zero and or reduce your income where you will fall into a lower tax bracket. Then, any excess money you want to save, deposit the rest into a TFSA. Remember, you can always withdraw that TFSA money and deposit that to an RRSP in the future, free of charge and without any tax consequences. Of course, financial planning is not a one-size-fits-all process, and therefore suggesting that everyone follow a cookie-cutter approach is frankly negligent. This is why at Joe Blow Financial, we believe in meeting with all of our clients to better understand their current financial position and what they are hoping to accomplish. After all, you wouldn't get a prescription without first receiving a diagnosis from a doctor, so why would you take financial advice without your planner knowing your overall financial position?